The number one infinite banking question I'm asked is, how much money will I need to start one of these policies? Well, this video is going to answer that. So, as always, people will say, well, how much is it? The truth is, typically you could start with as little as $1,000 per year. But there's a few things that really depends upon. One is, how old are you, right? Now, the older you are, the more the insurance costs. So when someone says, well, how much is it for me? Well, great. How old are you? Because if somebody's almost 70 years old, for example, you may not want to start with as little as $1,000 a year. You might want to start with at least $5,000, $10,000 a year as a minimum. I'm going to explain what that means later on because you'll find out there's some flexibility possible here. So if you're older, it might be $5,000 or $10,000. If you're younger, like if you're in your 20s, maybe even 30s, or even if you're buying for your children. By the way, you can buy policies on your family members. You can do that as well. It might be less than $1,000 a year. I have people that have kid policies, they're putting in a max of $5,000 a year, but the minimum is closer to about $700 or $800 a year. So you could actually even be less. So typically, what can you start with? Usually you need to be at least $1,000 a year is a minimum to really get to do something decent, okay? Now, like I said, the older you are, the more it's gonna cost, so be aware of that. But if you have someone who's a good infinite banker, they can really help you figure out the ins and outs of what that means. Now, the best infinite banking policies will allow you to have a range, like I just said, right? Because, like I mentioned, with children policies, you can have a maximum of $5,000, $10,000 a year going into these. By the way, you could be putting in possibly up to maybe even $20,000+ a year into each child's policy. Now, the minimum is roughly going to be about 15 to 20% of that maximum. Maybe a little less, maybe a little more, just depends, right? Now, for those of you that maybe are around your 30s, 40s, 50s, typically, way we design it, we try to make it a max ROI infinite banking policy. Understand that when the normal person sells you an infinite banking policy, or even just sells you a whole life policy for that matter, often your minimum is the maximum, or the maximum is the minimum, whatever way you look at it. So if they tell you you're putting in $10,000 a year, you have to put in $10,000 a year. That's the traditional whole life plan. That's the same ones that the Dave Ramseys and the Susie Ormans rip on and say it's a waste of money, and I agree. It's a waste of money if you do those kind of plans. Don't do what they call base only life insurance, which means those first 2 years, pretty much all your money is going to pay for insurance costs and commissions. That's why advisors love selling it. That's also what insurance companies teach advisors to sell. So it's not just the insurance agent's fault here. More often than not, it's the insurance company teaching them to sell the traditional product just like little robots, right? We want to make sure you do it the right way. So when we have you design it, we try to make sure there's a range, right? There's a bigger range on it. So for most people, usually it's 1/4 to 1/5 is the minimum compared to the maximum. So if the maximum you pick, say, is $25,000 a year, the minimum may only be about $4,000, $5,000, maybe $6,000 a year, just depending on your age and your health situation. That's the other thing too. Your health can actually determine how much the costs are and what the minimum is going to be compared to the maximum. But more often than not, a general rule of thumb is that the minimum is going to be about 1/4 or 1/5 of the maximum. So if it's $10,000 a year, your minimum may only be about $2,000, $2,500 a year. That's it. That's what you're actually required to put in. You're not required to put in the max when you use a max ROI infinite banking policy like what we do. We want to make sure you get the max ROI. Get it? That's why. Again, you want to make sure you have the lowest cost, highest returns so that your policy can grow faster. Here's the other cool thing. Did you know that because of the way these things are designed, if you design with this kind of range and you're actually max funding it, usually by the 3rd year of that policy, it's actually paying for itself already. The policy is already making more money than what you're putting in. It literally becomes a tax-free supercharged savings account because despite the insurance costs coming out in year 3, you're making more money than that. So that's a key thing is that usually by year 3 or 4, this sucker's paying for itself. So you want to make sure you get a range. This is also good for another reason. Have you ever had anything unexpected happen in your life? If you're a human and you've lived beyond one day, and actually if you're a day old, you've probably had unexpected things happen in your life. None of us have a crystal ball. None of us know the future or know exactly what's going to happen. You need flexibility. You need to be able to adjust if life changes. I had a client just recently where he said, Chris, I know I'm putting in $30,000 a year in this plan. I can't do that this year. And I said, okay, that's okay. What's going on? He's like, oh, well, it's just, money didn't get paid back from some business stuff that I was dealing with. So it's going to be a little bit longer. I mean, can I pay it later in the year? And I said, well, good news, because that $30,000 a year max that you have on there, you only have to pay about $6,500 this year. Well, I have $6,500. Well, great. Well, then just pay that. I can do that? Yes. You don't have to pay $30,000. You just need to pay the minimum. That's all the insurance company cares for. The extra you're paying is all going to your account. So they don't care about that money. They care about you paying at least that minimum. He said, great, thank you, Chris. Awesome. And so he did it, and it was fine. And then a few months later, he put in a little bit more to build up the cash again. Another client, it was more dire than that. He said, Chris, I don't even have the money to put in, even for the minimum. And I said, well, guess what? Good news. You actually have cash in your policy, because the way we design it, usually at least 75% of your money is in there from day one that you put into it. So if you put in $20,000 that first year, you usually have at least $15,000. But if you put in $20,000, your minimum might only be $4,000, $5,000. Well, guess what? You can always borrow that $4,000 or $5,000 from the $15,000 and put it right back into your policy again. It's like taking your savings and putting it back into your savings account. Yes, there's some cost to it with the insurance cost, but ultimately, depending on which year you're doing this in, it might already be paying for itself anyways. You might be fine. And so I told him, I said, here's what we're gonna do. We're gonna borrow the money to then put it back in. And he was able to do that. In many of our cases, our clients could do that forever after the first or second year. So there's lots of flexibility if you do it with a range. Do not, again, I warn you, do not buy the traditional whole life policies where all of your money is going to insurance costs and commissions in the first 2 years. Now, here's the next question that people often ask me. Well, Chris, how do I determine how much to put into this? How do I know what that max should be or that minimum or whatever? Well, first, we already know the minimum. Like, you want to be able to feel comfortable with that, because that's what needs to go in. Even if you have the cash there, you still need to make sure you make that each and every year. This is the easy way I look at it. Find out how much you're actually putting away to savings each year. This could also be savings you're putting into your 401k. If you're loading your 401k up, many of our clients will actually stop putting money in their 401k. Because you put your money in the 401k, it's gone, you can't do anything with it, and then you're subject to the bipolar stock market. But if you were to take that money from there, plus whatever money you've been putting into savings, even for emergency funds, maybe you're saving for taxes or for vacations, whatever it might be, that money you're taking, you can then put into this plan. Here's the warning. A lot of infinite bankers out there will tell you to put everything into here. They'll even try to convince you to put your whole paycheck in. Do not do that at all. That's just a marketing ploy, a little sales ploy to get them to pay them more money, not you. Don't do that. If you're putting away, say you're putting away $10,000 a year, the maximum that you pick on that policy shouldn't be $10,000 a year. Maybe $8,000 a year, right? Give you a little buffer, knowing that your minimum might only be $2,000 a year, because you know you can do that. If you're saving $10,000 a year, you only have to save $2,000. Much easier to do, isn't it? If I have many people that might be saving $5,000 a month or $60,000 a year. We won't put $60,000 a year into the policy. We'll probably put maybe $40,000 or $50,000 max, knowing that the minimum would be maybe about $8,000 or $10,000. Does that make sense? You kind of see where this is going? You want it to be flexible, but you don't want to put every single dollar you have into these policies. I know there'll be lots of insurance agents. Oh, bonus tip. Some insurance agents out there will tell you if you get a lump sum of cash, put it all in. Don't do that. Don't throw it all in. If you got $200,000 sitting in an account, don't throw all $200,000 in and then just pay the minimum after that. It pays them more money, but costs you more money. And that's, to me, just unethical. That's borderline unethical if it's not unethical by itself. Don't do that. Instead, base it on how much you're actually saving right now, each and every year. This should be your tax-free supercharged savings account that you're using to allow your money to grow and build so that you can use it. And then, as we talk about here, instead of just letting it grow for retirement, which is what a lot of them teach, you could actually use that policy today, especially if it's set up with this max ROI type of method. Because when you've got cash in there, you can then access it, whether you withdraw it or get a loan against it. You can access that money and then use it to invest and make cash flow now, which, by the way, guess what? Helps you make more payments. So I'll give you an example. I had a client that said he was putting away $200,000 a year into his savings account, wanting to invest it, wanting to buy real estate. And he had also about $2 million he could invest with. I said, listen, that $2 million, let's not put it all into life insurance, because he had a guy telling him, hey, put in $500,000 right now. I said, don't do that. Don't just dump them in a bunch of cash. Instead, we already know you can do $200,000 a year, but let's do this. Let's take that $2 million. Well, we'll take $200,000. We'll fund your policy for the first year. But that other $1.8 million we'll invest, generating another $180,000 or more per year. So along with the $200,000 plus $180,000, that's $380,000 that now he can use to fund $200,000 a year into his policy. Same thing's true for somebody else. They only had $200,000 to invest. Great. Maybe you set up a policy putting in $30,000 a year, but now you get the other $170,000 you can invest, making $17,000 a year, and almost pay for your policy for you. Again, you don't want to rely solely on that, but it's a great way to do it. So guys, That's the key thing is first, how much can you put in? How old are you, right? You can start with as little as $1,000 a year in many cases, but if you're older, you might have to start with more. But remember, the key is make it flexible so you can put in more, but still have a lower minimum in case crap hits the fan or life happens too fast. You wanna make sure that you're safe no matter what, and this policy actually works for you instead of working for the insurance agent to make them more money. By the way, if you thought this video was great, check out how to buy a car with infinite banking, or should you? Check it out.